What if I told you that the decision you make in the next few minutes could determine whether you retire wealthy or whether you spend the rest of your life working for someone else? This is not an exaggeration. This is not clickbait. This is the raw, unfiltered truth that the wealthy have known for generations. You see, there are two primary vehicles that ordinary people use to build extraordinary wealth. Two paths, two choices, and the path you choose will shape your financial destiny forever. The stock market has created millionaires. Real estate has created billionaires. But here's the thing that nobody tells you. It is not about which one is better. It is about which one is better for you. Welcome to the most comprehensive breakdown of real estate investing you will ever watch. Over the next 100 chapters, I am going to take you on a journey that will transform you from a complete beginner into someone who truly understands how wealth is built. Are you ready? Let me hit you with some facts that will absolutely blow your mind. Since 1971, with the average annual return of the stock market, specifically the S&P 500, has been approximately 10.5% per year. That sounds pretty good, right? 10% annually. Compound that over 30 years, and you've got yourself a nice little nest egg. Because here is where things get interesting. The average annual appreciation of real estate in the United States has been approximately 3.8% per year. 3.8% versus 10.5%. The stock market wins, right? Wrong. And this is the trap that keeps 90% of people from ever building real wealth. You see, that 3.8% does not tell the whole story, not even close. Here is what the financial gurus on television will never tell you. Real estate is not about appreciation alone. It is about something far more powerful, something called leverage. Let me break this down for you in a way that will make your jaw drop to the floor. When you invest $100,000 in the stock market, you control $100,000 worth of stocks. Simple mathematics, right? But when you invest $100,000 in real estate, you do not just control $100,000 worth of property. Oh no, you could control $500,000 worth of property. How? Because of a little thing called a mortgage, with just 20% down. That $100,000 becomes your down payment on a $500,000 property. Now, when that property appreciates by 3.8%, you are not making 3.8% on $100,000. You are making 3.8% on $500,000. That is $19,000 in appreciation alone. Do the math. That is a 19% return on your investment. And we have not even talked about cash flow yet. Albert Einstein reportedly called compound interest the eighth wonder of the world. But I am going to make a bold statement right now. Cash flow might just be the ninth wonder of the world. Here is why. Imagine this scenario. You own a rental property that brings in $2,000 per month in rent. Your mortgage payment, including taxes and insurance, is $1,400 per month. That leaves you with $600 in positive cash flow every single month. That is $7,200 per year. Pure profit flowing into your pocket while you sleep. The stock market does not send you monthly checks. Dividend stocks, sure, they pay quarterly. But we are talking about maybe 2 to 3% yields on average. Estate cash flow can generate 8%, 10%, sometimes even 15% cash-on-cash returns. Now here is where real estate becomes absolutely unstoppable. You are not making money in just one way. You are making money in three ways simultaneously. This is what I call the triple threat of real estate wealth. First, you have appreciation. Your property goes up in value over time. Second, you have cash flow. Tenants pay you rent every single month. Third, and this is the one that most people completely overlook, you have principal paydown. Every single month, your tenant is paying down your mortgage. They are literally buying this property for you. After 30 years, you own the property free and clear. But you did not pay for it. Your tenants did. Tell me one stock that pays you monthly, increases in value, and has someone else buying it for you. I will wait. Oh, you thought we were done? We have not even scratched the surface. Let us talk about something that the wealthy use to legally pay almost zero taxes. The tax advantages of real estate. When you own stocks and they pay dividends, you pay taxes. When you sell stocks for a profit, you pay capital gains taxes of 15 to 20%. But real estate plays by completely different rules. You can depreciate your property over 27.5 years for residential real estate. What does that mean? It means the government lets you deduct a portion of your property's value from your taxable income every single year. A $500,000 property, you can deduct over $18,000 annually. Even if your property is going up in value, it is like the government is paying you to be a real estate investor. hold on to your seats because this next strategy is absolutely mind-blowing. It is called the 1031 exchange, and it allows you to do something that sounds almost illegal, but is completely within the law. Let us say you bought a property 10 years ago for $200,000. Today, it is worth $500,000. You have made $300,000 in profit. Normally, you would owe capital gains taxes on that profit. We are talking about $60,000 or more, going straight to the government. But with a 1031 exchange, you pay nothing, zero. As long as you reinvest that money into another qualifying property within 180 days, you defer all of your taxes. And here's the kicker. You can keep doing this over and over and over again, build wealth for decades, and never pay a single dollar in capital gains taxes. Now listen. I am not here to tell you that the stock market is bad. Millions of people have built wealth through stocks. But there is a fatal flaw that you need to understand. When you invest in stocks, you have absolutely zero control. Think about it. You buy shares of a company, and what happens next is completely out of your hands. The CEO makes a bad decision. Your stock crashes. A competitor releases a better product. Your stock crashes. A global pandemic hits. Your stock crashes. You are at the mercy of factors completely beyond your control. But real estate, you are in control. You choose the property, you choose the tenants, you choose when to raise rents, you choose when to renovate, you choose when to sell. This level of control is priceless. Let me paint a picture for you. It is March of 2020. The world is shutting down. Fear is everywhere, and the stock market, it crashes by 34% in just 23 trading days. If you had $1 million invested, you just lost $340,000. Gone, vanished in less than a month. Now, real estate did experience uncertainty during that time too. But here is the difference. Your property did not lose 34% of its value overnight. Real estate moves slowly. It gives you time to adjust until it bounces back. And unlike stocks, you still collected rent checks. Your tenants still needed a place to live. That monthly cash flow kept coming in, even during the worst economic crisis in recent memory. Stability, my friends. That is worth its weight in gold. Here is something that nobody talks about, the psychological advantage of real estate investing. And trust me, this matters more than you think. When you own stocks, what do you have? Numbers on a screen. Abstract figures that go up and down every single day. It is so easy to panic sell when those numbers drop. Studies show that the average stock investor earns only about 6% annually, even though the market average is 10%. Why? Because people buy high and sell low. They let their emotions destroy their returns. But real estate is real. You can touch it, you can see it, you can walk through it. When the market gets rough, you do not just panic and sell your house. There is a tangible physical asset that grounds you. This psychological stability helps investors stay the course and build real wealth over time. Inflation, the silent wealth killer that robs you of your purchasing power every single year. In 2002, inflation hit 9.1%, the highest in over 40 years. Your dollars were literally becoming worth less with each passing month. But here's the beautiful thing about real estate. It is one of the best inflation hedges in existence. When inflation rises, rents rise. When inflation rises, property values rise. Your real estate investment actually benefits from inflation. Meanwhile, cash sitting in a savings account earns maybe 0.5% interest while losing 9% to inflation. You are going backwards. Real estate investors. We are moving forward. Inflation makes us richer while it makes everyone else poorer. Let me ask you a question. How much money would you need to generate $10,000 per month in passive income from the stock market? Let us do the math. If we assume a 4% dividend yield, which is actually pretty generous, you would need $3 million invested to generate $10,000 monthly. $3 million. How long would it take you to save that much? But with real estate. And you have hit that $10,000 mark. And here is the thing. You do not need to buy those 20 properties with cash. With leverage, smart financing, and strategic acquisitions, you could reach that goal with far less capital. This is how ordinary people achieve extraordinary results. Now let us talk about time, because time is the one resource that none of us can get back. The stock market absolutely requires time to generate significant returns. Decades of time. If you invested $10,000 at age 25 with a 10% annual return, by age 65, you would have approximately $453,000. Not bad, right? But that required 40 years of patience. With real estate, you can dramatically accelerate this timeline using leverage, cash flow, and strategic refinancing. You could potentially reach that same wealth level in 15 to 20 years. Maybe even faster. When you are young, you want to build wealth fast. Real estate gives you the tools to do exactly that. I am going to give you a little preview of something we will dive deep into later. A strategy called BRRRR, buy, rehab, rent, refinance, repeat. This single strategy has created more millionaires in the past decade than almost any other real estate method. Here is the basic concept. You buy a distressed property below market value. You renovate it, increasing its value dramatically. You rent it out to generate cash flow. You refinance based on the new, higher value, pulling out most or all of your original investment. And then you repeat. You literally get your money back and still own a cash-flowing asset. Do this 10 times, and you own 10 properties with almost none of your own money left in them. This is the power of real estate that stocks simply cannot match. So, after everything we have discussed, what is the verdict? Which one will make you more money? Here is my honest answer. It depends on you. If you want truly passive investing, have a long time horizon, and do not want to deal with tenants or maintenance, the stock market is a solid choice. Invest in low-cost index funds and let time do its magic. But if you want to build wealth faster, if you want multiple income streams, if you want tax advantages, leverage, and control, real estate is the answer. The wealthiest families in the world, the Rockefellers, the Trumps, the Waltons, they all built their fortunes on real estate. This is not a coincidence. This is the blueprint. Before we talk about strategies, before we talk about money, before we talk about anything else, we need to address the most important factor in your success: your mindset. 90% of people who want to invest in real estate never actually do it. They read books, they watch videos, they analyze deals, but they never take action. Why? Because they are trapped in a mindset of fear and scarcity. They think they need more money. They think they need more knowledge. They think they need the perfect deal. But here is the truth that nobody wants to hear. You will never be completely ready. There will always be more to learn. There will always be risks. There will always be uncertainty. The difference between successful investors and everyone else. Successful investors take action despite the fear. Let us destroy one of the biggest myths in real estate right now. The myth that you need hundreds of thousands of dollars to get started. This is absolutely categorically false. There are investors right now who started with less than $5,000. There are investors who started with $0 of their own money. How is this possible? Creative financing, partnerships, seller financing, house hacking. There are so many strategies that eliminate the need for massive capital. Now, having money certainly makes things easier. Having 20 to 25% for a down payment opens more doors. But if you are sitting there thinking you cannot start because you do not have enough money, you are using that as an excuse. An excuse to stay comfortable, an excuse to stay safe, an excuse to stay poor if you are a complete beginner with limited funds. I want to introduce you to the most powerful strategy for getting started. It is called house hacking, and it is absolute genius. Here is how it works. You buy a property that you live in. Maybe it is a duplex, triplex, or fourplex. Maybe it is a single-family home with extra rooms. You live in one unit or one room, and you rent out the rest. Your tenants pay your mortgage for you. In many cases, you can live completely free while building equity and learning the real estate business. FHA loans allow you to purchase properties with just 3.5% down on a $200,000 duplex. That is only $7,000. You become a landlord, build equity, live for free, and learn the business, all with one simple transaction. Now, before you rush out and make your first purchase, stop. There is an investment you need to make first, and it does not require any money. That investment is education, not college education, real estate education. Read books, listen to podcasts, watch videos like this one, attend local real estate investor meetups. Some of the best investors in the country spend 1 to 2 hours every single day learning and improving their craft. You do not need to know everything before you start, but you need to know enough. You need to understand basic terminology. You need to understand how to analyze deals. You need to understand your local market. The good news: most of this education is completely free. You have no excuse not to learn. Real estate is local. What works in Los Angeles does not work in Cleveland. What works in Miami does not work in Detroit. You must understand your market. Start by researching population trends. Is your city growing or shrinking? Look at job growth. Are major employers moving in or moving out? Research median home prices and median rents. What is the price to rent ratio? Generally speaking, markets where you can buy a property for 100 times the monthly rent are considered good cash flow markets. A property that rents for $1,500 per month in a market where similar homes sell for $150,000. That is a solid opportunity. But a property that rents for $2,000 in a market where homes sell for $800,000. That is a terrible investment for cash flow. Know your numbers. Know your market. Here is a truth bomb that might hurt to hear. You cannot do this alone. Every successful real estate investor has a team behind them. At minimum, you need a reliable real estate agent who specializes in investment properties. You need a lender who understands creative financing. You need a home inspector who will tell you the truth about a property. You need a reliable contractor for repairs and renovations. You need an accountant who understands real estate tax strategies. And eventually, you need a property manager to handle day-to-day operations. Building this team takes time, it takes effort. You will make mistakes and work with wrong people along the way, but once you have a solid team in place, your business becomes a well-oiled machine that generates wealth almost automatically. The real estate business is built on relationships. The best deals, the ones you never see on the MLS, come from relationships. Attend every real estate investor meetup in your area. Join online communities and forums. Connect with other investors on social media. When you meet someone successful, offer value first. Do not just ask for help. Ask how you can help them. Maybe you can analyze deals for them. Maybe you can bird dog properties. Maybe you can manage a renovation. When you provide value to others, they will provide value to you. Some of the best partnerships, some of the most lucrative deals, some of the biggest opportunities come from a single conversation at a networking event. Never underestimate the power of human connection. Let us talk about money, specifically, where it comes from and how you can access it. Traditional financing through banks and mortgage lenders is the most common route. You need a decent credit score, typically 620 or higher for investment properties. You need income documentation, you need reserves, and you need a down payment, usually 15 to 25% for investment properties, but this is just the beginning. There is FHA financing for house hacking with 3.5% down. There is VA financing for veterans with 0% down. There are portfolio lenders who look at the deal more than your personal finances. There is hard money lending for fix and flip projects. There is private money from individual investors. There is seller financing where the seller acts as the bank. The options are endless if you know where to look. Before you start shopping for properties, you need to get pre-approved for a mortgage. This step is absolutely critical. A pre-approval letter tells sellers that you are a serious buyer with financing already lined up. Without it, sellers will not even look at your offers. To get pre-approved, you will need to provide income documentation, W-2s, tax returns, pay stubs. You will need to show your assets, bank statements, investment accounts, and they will pull your credit report. The process typically takes a few days to a week. Once approved, you will know exactly how much you can borrow. This gives you a clear budget and allows you to search for properties with confidence. Do not skip this step. Rookies who skip this step waste months looking at properties they cannot afford. This is where the rubber meets the road. Analyzing deals is the core skill that every investor must master. For rental properties, you need to understand a few key metrics. First is net operating income, your total rental income minus your operating expenses. This does not include mortgage payments. Then there is cash flow. What remains after you pay the mortgage? A deal that makes sense is typically one that provides at least $100 to $200 per month per unit in cash flow. Then there is cash-on-cash return, your annual cash flow divided by your total cash invested. Most investors target 8 to 12% cash-on-cash returns. Finally, there is cap rate, your net operating income divided by the purchase price. Different markets have different cap rates, but generally, 5 to 8% is considered decent. Learn these numbers. Read these numbers. Here is a quick rule of thumb that will save you hours of analysis time. It is called the 1% rule. A property potentially makes sense as a rental if the monthly rent is at least 1% of the purchase price. A $100,000 property should rent for at least $1,000 per month. A $250,000 property should rent for at least $2,500 per month. If a property does not meet the 1% rule, it might still work, but it requires deeper analysis. If a property exceeds the 1% rule, You might have a winner on your hands. This is not a perfect metric, and it does not work in every market. High appreciation markets like San Francisco will almost never meet this rule. Here's a fantastic quick filter to eliminate bad deals fast. Here is another rule of thumb that will make your analysis faster and more accurate. The 50% rule. Approximately 50% of your rental income will go to operating expenses over time. This includes property taxes, insurance, maintenance, repairs, vacancy property management, and capital expenditures. If a property rents for $2,000 per month, assume $1,000 will go to expenses. That leaves $1,000 to cover your mortgage payment. If your mortgage is $800, you have $200 per month in cash flow. If your mortgage is $1,200, you are losing $200 per month. This rule is not exact, but it is surprisingly accurate for most properties. Use it for quick analysis, then dig deeper into the actual numbers for properties that pass the initial screening. You have found a property that meets your criteria. The numbers work. Your heart is racing. Now what? It is time to make an offer. Work with your real estate agent to submit a written offer. Your offer should include your purchase price, earnest money deposit, financing contingencies, inspection contingencies, and your proposed closing date. Here is a secret that most beginners do not know. Your first offer should not be your best offer. Start lower than you think. The worst thing that can happen is the seller says no or they counter. Real estate is a negotiation. The asking price is just a starting point. I have seen investors pay $50,000 below asking price simply because they had the courage to make a lower offer. Do not be afraid to negotiate. Your offer has been accepted. Congratulations. But do not celebrate yet, because this is where the real work begins. You typically have 7 to 14 days for due diligence, depending on your contract. During this time, you need to complete your home inspection. Every property has issues. The question is whether those issues are deal breakers. You need to review the title report for any liens or encumbrances. You need to verify rental income if the property has existing tenants. You need to finalize your financing with your lender. If you discover major issues during due diligence, you can renegotiate the price, ask for repairs, or walk away. Your earnest money is typically protected during this period. Do not rush through due diligence. This is your protection against making a costly mistake. The inspections are complete, the financing is approved, title is clear, it is closing day. You will meet at the title company or attorney's office to sign approximately 1 million documents. Okay, maybe not 1 million, but it will feel like it. You will sign the promissory note, the mortgage, the deed, and dozens of disclosure documents. You will provide your down payment and closing costs via certified check or wire transfer. Total closing costs typically run 2 to 5% of the purchase price. Once everything is signed and funds are transferred, you are a real estate investor. They will hand you the keys to your property. This moment, this feeling of holding those keys for the first time, is something you will never forget. Your journey has officially begun. If you purchased a vacant property, your next mission is critical. You need to find a qualified tenant as quickly as possible. Start by researching comparable rentals in your area. Price your property competitively, maybe even slightly below market to minimize vacancy. Take professional photos, write a compelling listing description, post on Zillow, Apartments.com, Facebook Marketplace, and Craigslist. When inquiries start coming in, screen thoroughly, check credit scores, look for 650 or higher. Verify income. Tenants should earn 3 times the monthly rent. Call previous landlords, not just the current one, as they may lie to get rid of a bad tenant. Run criminal background checks. Check for prior evictions. Your tenant can make or break your investment. And never skip screening to fill a vacancy faster. A bad tenant will cost you far more than an extra month of vacancy. Your tenant is screened and approved. Now you need a bulletproof lease agreement. Do not use a generic lease you found online. Every state has different landlord-tenant laws. Your lease must be specific to your state and your property. Include clear terms about rent amount, due date, and late fees. Typical late fees are 5 to 10% of monthly rent. Include pet policies. If you allow pets, charge a non-refundable pet deposit and pet rent. Include maintenance responsibilities. Who handles lawn care, snow removal. Include rules about noise, guests, and property modifications. Include early termination clauses. Include your right to enter the property for inspections with proper notice. Every detail matters. A well-written lease protects you legally and sets clear expectations. Here is something that might surprise you. Being a good landlord actually makes you more money. Respond to maintenance requests quickly. Happy tenants stay longer, reducing turnover costs. Be professional but personable. Treat your tenants with respect and dignity. They are not just rent checks, they are human beings living in your property. Follow the law. Know your state's landlord-tenant regulations inside and out. Never discriminate based on race, religion, gender, family status, or disability. That is illegal, immoral, and will destroy your business. Conduct regular property inspections, typically once or twice per year with proper notice. Catch small problems before they become expensive disasters. Good landlording is not about being nice or being tough. It is about being fair, consistent, and professional. You own your first property. It is rented. Cash is flowing. But do not get complacent, because now is the time to accelerate your wealth building. Every month, a portion of your tenant's rent payment goes toward paying down your mortgage principal. This is for savings that builds your equity automatically, but you can accelerate this. Make extra principal payments when possible. Even an extra $100 per month can take years off your mortgage. Complete strategic improvements that increase property value. A $5,000 kitchen refresh could add $20,000 in value. Raise rents annually to keep pace with market rates. Most landlords underprice their rentals because they are afraid to raise rents. Do not leave money on the table. Every dollar of increased rent adds to your net operating income and property value. One property is a start, but one property will not make you wealthy. Build relationships with private money lenders who might fund your deals. Look for partnerships where you provide the work and someone else provides the capital. The hardest part is going from 0 to 1. Going from 1 to 2 is actually easier because you now have experience. You have a track record. You have proven you can do it. Use that momentum to keep pushing forward. Not all real estate is created equal. There are many different property types, and each has its own characteristics. Single-family homes are the most common starting point for beginners. One house, one tenant, or family. Easy to understand, easy to manage, easy to sell. Duplexes, triplexes, and fourplexes are called small multifamily. You get multiple rent checks from one property, reducing risk. Anything 5 units or more is considered commercial multifamily, with different financing rules. Then there is commercial real estate, office buildings, retail spaces, industrial properties. There is vacant land, mobile home parks, self-storage facilities. Each property type has different return profiles, different risks, and different strategies. For beginners, I recommend starting with single-family homes or small multifamily. Master these before moving to more complex property types. You have heard this phrase 1,000 times. But do you really understand what it means? Location determines appreciation potential. A property in a growing neighborhood will increase in value faster than an identical property in a declining area. Location determines tenant quality. Better neighborhoods attract better tenants who pay on time and care for the property. Location determines rent levels. The same square footage commands different rents based entirely on location. Location determines your exit options. Properties in desirable locations sell faster and for more money. When evaluating location, look at school districts, crime rates, proximity to employment centers, access to public transportation, and neighborhood trends. Is the area getting better or getting worse? Buy in the path of progress wherever possible. Real estate investors categorize properties into classes based on their age, condition, location, and tenant profile. Class of properties are the cream of the crop. New construction or recently renovated in the best neighborhoods with high-income tenants. They command premium rents but offer lower cash-on-cash returns. Class B properties are solid, older but well-maintained in good neighborhoods with middle-income tenants. These often offer the best balance of cash flow and appreciation. Class C properties are older buildings in working-class neighborhoods with lower-income tenants. Higher cash flow potential but more management intensity and higher risk. Class D properties are in rough neighborhoods, often with deferred maintenance and problematic tenants. High risk, but some investors specialize here and make great money. Most beginners should focus on Class B and C properties for the best risk-reward balance. Real estate moves in cycles. Understanding where your market sits in the cycle is crucial for making smart investment decisions. Phase 1 is recovery. The market has bottomed out after a decline. Vacancy rates are high, rents are flat, and new construction has stopped. This is actually an excellent time to buy. Prices are low, and upside potential is huge. Phase 2 is expansion. The economy is improving. vacancy rates fall, rents rise, and new construction begins. This is when most investors start paying attention. Phase 3 is hypersupply. Developers have overbuilt, new construction has outpaced demand, vacancy starts rising, and rent growth slows. Phase 4 is recession. Too much supply meets declining demand. Rents fall, vacancy rises, and values decline. This is when weak investors panic and sell, creating opportunities for smart investors to buy. I cannot stress this enough. Cash reserves are non-negotiable. Real estate is not liquid. When emergencies happen, you need cash on hand. At minimum, maintain 3 to 6 months of expenses for each property you own. If your mortgage, taxes, insurance, and maintenance average $2,000 per month, you need $6,000 to $12,000 in reserves for that property. What happens when your furnace dies in January? What happens when your tenant stops paying rent? What happens when a tree falls through the roof? These things will happen. It is not a question of if, but when. Investors who do not maintain adequate reserves are forced to sell properties at bad times, take on expensive debt, or face foreclosure. Do not be that investor. Build reserves before you have problems. When you own rental properties, things break. You will constantly face a choice. Do it yourself or hire it out. If you are handy and enjoy the work, DIY can save you thousands of dollars. Basic repairs like fixing leaky faucets, patching drywall, replacing light fixtures, these are easy and cheap to do yourself. But be realistic about your skills and your time. If you make $50 an hour at your job, is it worth spending 4 hours on a repair that a professional could do in 1 hour for $100? Probably not. For anything involving electrical, plumbing, vac, or structural work, hire a professional. A botched DIY job can cost you far more in the long run. Liability issues, code violations, and property damage are not worth saving a few $100s. Know your limits. One of the biggest decisions you will make is whether to manage properties yourself or hire professional property management. Self-management means you handle everything: finding tenants, collecting rent, coordinating repairs, dealing with complaints, handling evictions. This saves money, typically 8 to 10% of monthly rent for professional management, but costs time and energy. Professional management handles everything for a fee. They have systems, experience, and scale. They deal with the midnight toilet emergencies and the difficult tenants. For your first few properties, I recommend self-managing. You need to understand the business from the ground up. You need to experience the challenges firsthand. Once you own more than 10 units, or you are investing out of state, professional management becomes essential. Cap rate is one of the most important metrics in real estate investing, but it is also one of the most misunderstood. Cap rate stands for capitalization rate. It is calculated by dividing the net operating income by the purchase price. A property with a net operating income of $40,000 and a purchase price of $500,000 has a cap rate of 8%. But what does this actually mean? The cap rate tells you what your return would be if you paid cash for the property. It allows you to compare properties of different prices and income levels on an equal basis. Higher cap rates indicate higher potential returns but also higher risk. And lower cap rates indicate lower returns but often in safer, more stable markets. Cap rates vary widely by market and property type. Know the typical cap rates for your market. While cap rate assumes an all-cash purchase, cash on, cash return reflects your actual return based on the money you invested. To calculate cash on cash return, divide your annual cash flow by your total cash invested. If you put $50,000 into a property and receive $6,000 per year in cash flow, your cash on cash return is 12%. I bet. This accounts for your mortgage payment, which cap rate ignores. Cash on cash return shows you how hard your money is working. A 12% cash on cash return means you are doubling your investment every 6 years just from cash flow alone. This does not include appreciation, principal paydown, or tax benefits. When you factor everything in, your total return could be 20, 30, even 40% annually. This is the power of leveraged real estate. Different markets offer different investment profiles. Some markets are appreciation markets. Some are cash flow markets. Very few offer both. Appreciation markets like San Francisco, Seattle, and New York have high property prices relative to rents. Cash flow is minimal or even negative, but over time, property values can increase dramatically. These markets work best for investors with long time horizons who do not need immediate income. Cash flow markets like Cleveland, Memphis, and Indianapolis have low property prices relative to rents. You can achieve great cash on cash returns immediately, but appreciation is often slower. These markets work best for investors who need income now. Some markets like Dallas, Phoenix, and Atlanta offer a balance of both. Decide what is more important for your situation and invest accordingly. When you start investing in commercial real estate or larger multifamily properties, lenders will scrutinize your debt service coverage ratio. DSS, SES, SEU PROCRIs of the ratio of your net operating income to your annual debt payments. If your property generates $200,000 in NOI and your annual mortgage payments total $160,000, your D-ester is 1.25. Lenders typically want to see a D-ester of at least 1.25 for commercial properties. This means there is enough income to cover the debt with a 25% buffer. If your D-ester is below 1, the property does not generate enough income to cover the mortgage. This is a problem. Banks will not lend, and you will have to bring cash out of pocket to cover shortfalls. Always verify that a property can achieve adequate DSCR before making an offer. Let us go deeper into depreciation because this tax benefit is absolutely massive. The IRRRRs allows you to depreciate residential rental property over 27.5 years on a $500,000 property, assuming the land is worth $100,000. You can depreciate $400,000 over that period. That is approximately $14,500 per year in deductions. This reduces your taxable income even though the property may be going up in value. This is a paper loss that provides real tax savings. If you are in the 24% tax bracket, that depreciation saves you $3,480 in taxes annually. Multiply that across multiple properties and decades of investing. The tax savings are enormous. This is one reason why the wealthy pay lower effective tax rates than middle-class workers. Once you own larger properties, you should consider an advanced strategy called cost segregation. Normal depreciation spreads deductions over 27.5 years, but cost segregation allows you to accelerate depreciation by identifying components that can be depreciated over 5, 7, or 15 years instead. Things like appliances, carpeting, landscaping, parking lots. These can be front-loaded. A cost segregation study might allow you to take $200,000 in depreciation deductions in year 1 instead of spreading it over nearly 3 decades. This creates massive paper losses that offset your income. When combined with other strategies, investors can often pay zero federal income tax. This is completely legal and is exactly what sophisticated investors do. Hire a qualified cost segregation firm once you have properties worth $500,000 or more. We touched on 1031 exchanges earlier. But this strategy is so powerful that it deserves a deeper exploration. A 1031 exchange allows you to defer all capital gains taxes when selling an investment property and purchasing another. The rules are strict. You must identify replacement properties within 45 days of selling. You must close on the replacement property within 180 days. You must use a qualified intermediary to hold the funds. You cannot touch the money yourself. The replacement property must be of equal or greater value to defer all taxes. You can exchange multiple properties for one or one property for multiple. The properties must be like-kind, but this is broadly defined for real estate. You can exchange a rental house for an apartment building or a retail center for vacant land. The true power of 1031 exchanges reveals itself over time. Imagine you buy a property for $300,000. It appreciates to $500,000 over 10 years. You do a 1031 exchange into an $800,000 property. That property appreciates to $1.3 million over another 10 years. You exchange into a $2 million property. You have now accumulated over $1.7 million in gains, and you have paid zero taxes. When you eventually die, your heirs receive a stepped-up basis. This means the capital gains you accumulated literally disappear. Your heirs can sell for the current market value and owe nothing. This is how wealthy families preserve and transfer wealth across generations. The 1031 exchange is the ultimate wealth-building tool. Here is a strategy that most people have never heard of. Investing in real estate through a self-directed IRA. A self-directed IRA allows you to invest retirement funds in alternative assets, including real estate. You can buy rental properties, flip houses, or invest in real estate syndications, all within your IRA. The profits grow tax-free in a Roth IRA or tax-deferred in a traditional IRA. There are strict rules. You cannot use the property yourself. You cannot perform work on the property yourself. You cannot sell to or buy from family members. All income and expenses must flow through the IRA. But if you follow the rules, you can build a real estate empire within your retirement account. Your profits compound without annual tax drag. This is an incredibly powerful but underutilized strategy. What if you want the returns of real estate without the day-to-day hassles of being a landlord? Syndications might be your answer. A syndication is when a group of investors pools money to purchase a larger property than any individual could buy alone. A syndicator or sponsor identifies the deal, manages the property, and makes all operational decisions. Passive investors provide capital and receive a share of cash flow and profits. Typical syndication minimums range from $25,000 to $100,000. Returns vary but often target 8 to 10% annual cash flow plus upside from appreciation. Hold periods are typically 3 to 7 years. As a passive investor, you do almost nothing. You invest, receive quarterly distributions, and eventually receive your share when the property sells. This is true passive income. Not all syndication sponsors are created equal. Due diligence on the sponsor is just as important as due diligence on the deal. How long has the sponsor been investing? You want someone with at least 5 to 10 years of experience. What is their track record? Have they successfully exited previous deals? What were the actual returns compared to projected returns? How did they perform during downturns like 2008 or 2020? What is their skin in the game? A good sponsor investors firsty investors trust them fall investors, typically 5 to 10% of the equity. How transparent is their communication? Do they provide regular updates and answer questions promptly? What do other investors say about them? Get references. Do not invest with a sponsor just because their projected returns look amazing. Projections are not guarantees. Real estate investment trusts, or REITs, are another way to invest in real estate without owning property directly. A REIT is a company that owns, operates, or finances income-producing real estate. By law, REITs must distribute at least 90% of their taxable income to shareholders as dividends. You can buy REIT shares just like stocks through any brokerage account. This provides incredible liquidity that direct real estate investing lacks. There are REITs specializing in apartments, offices, retail, healthcare facilities, data centers, cell towers, and more. Average REIT returns have historically been similar to the broad stock market, around 9 to 11% annually. The downside, you do not get the tax benefits of direct ownership. You cannot use leverage. You have no control. But for investors who want real estate exposure with minimal effort, platforms like Fundrise, CrowdStreet, RealtyMogul, and others allow you to invest in real estate deals with minimums as low as $500. These platforms pool investor money and invest in various real estate projects. Some focus on debt, lending money to developers and earning interest. Some focus on equity, owning shares of actual properties. Returns vary widely depending on the platform, strategy, and economic conditions. Typical targets range from 7 to 15% annually. Low minimums, diversification across many properties, and completely passive investing. The disadvantages: fees, lack of control, illiquidity, and platform risk. Always read the fine print and understand exactly what you are investing in. Your credit score is the key that unlocks real estate financing. A higher score means better rates and easier approvals. Most investment property lenders want to see a minimum credit score of 620 to 640, but the best rates go to borrowers with scores of 740 and above. To improve your credit, pay every bill on time. Payment history is 35% of your score. Keep credit utilization below 30%. Below 10% is even better. This is 30% of your score. Avoid opening new accounts before applying for a mortgage. Hard inquiries and new accounts temporarily lower your score. Check your credit reports for errors and dispute any inaccuracies. Old collections and judgments may be negotiable for pay-for-delete agreements. Building excellent credit takes time, but it is one of the best investments you can make. A 1% lower interest rate on a $500,000 mortgage saves over $100,000 over 30 years. There are many different types of loans available for real estate investors. Understanding your options is crucial. Conventional loans are offered by traditional banks and credit unions. They typically require 15 to 25% down for investment properties with good credit and income documentation. FHA loans are government-backed with only 3.5% down required. But you must live in the property, making them perfect for house hacking. VA loans are for veterans with zero down payment required. Again, you must occupy the property. Portfolio loans are kept in-house by smaller banks and have more flexible underwriting criteria. Commercial loans are for larger properties and focus more on the property's income than your personal finances. Hard money loans are short-term, high-interest loans used for flipping and renovation projects. Private money loans come from individual investors and have negotiable terms. Each loan type has its place. Match the financing to your situation and strategy. For investors who want to scale without being limited by personal income, DSR loans are a game changer. DSR stands for Debt Service Coverage Ratio. These loans qualify you based on the property's income, not your personal income. If the property generates enough rent to cover the mortgage with a buffer, you qualify. No tax returns required, no WOS required, no complicated income calculations. The loan qualifies based purely on the numbers of the deal. DSR loans typically require 20 to 25% down and have slightly higher interest rates than conventional loans, but the flexibility is incredible. You could have 100 rental properties and keep getting more loans as long as each property cash flows. This is how sophisticated investors scale rapidly without hitting income-based lending limits. When getting a mortgage, you will encounter points and various fees. Understanding these costs is essential. 1 point equals 1% of the loan amount. On a $400,000 loan, 1 point is $4,000. Points are essentially prepaid interest. Paying points lowers your interest rate over the life of the loan. Whether points make sense depends on how long you plan to hold the property. If paying 1 point saves you $50 per month, it takes 80 months to break even. If you plan to hold longer than that, points make sense. Well, common fees include origination fees, appraisal fees, title insurance, inspection fees, attorney fees, and recording fees. Total closing costs typically run 2 to 5% of the loan amount. Shop multiple lenders. Fees vary wildly between companies. Getting 3 to 5 quotes can save you thousands of dollars. Real estate investing is fundamentally about negotiation. Your profit is made when you buy, not when you sell. Everything is negotiable. The price, the terms, the closing date, who pays which closing costs, repairs and credits. What stays with the property? Everything. Research comparable sales thoroughly before making offers. Knowledge is power in negotiation. Understand the seller's motivation. Why are they selling? How quickly do they need to close? Are there multiple offers? Make your offer strong in ways that matter to the seller. Sometimes flexibility on closing date matters more than price. Always be willing to walk away. Your best negotiating position is genuine willingness to say no. Never get emotionally attached to a deal. There are always more properties. But at Station, never let desperation drive your decisions. The best deals are often ones you will never see on the MLS. These off-market opportunities require more effort to find, but the rewards are worth it. Direct mail campaigns to property owners can generate leads. A simple letter saying you are interested in buying their property works surprisingly well. Driving for dollars means physically driving through neighborhoods looking for distressed properties, then tracking down the owners. Networking with wholesalers gives you access to their deal flow. Building relationships with estate attorneys connects you with inherited properties. Divorce attorneys represent clients who need to sell quickly. Door knocking directly is uncomfortable but effective. Online platforms like Connected Investors and Deal Machine help find motivated sellers. The key is consistency. Most off-market strategies require sustained effort over months before producing results. Do not give up after a few weeks. Wholesalers find properties under contract and then assign those contracts to investors for a fee. They can be a valuable source of deals. A good wholesaler brings you properties at below market prices. They do the marketing, negotiating, and legwork. You pay an assignment fee, typically $5,000 to $20,000, and get a property with built-in equity, but buyer beware. Many wholesalers are beginners who have no idea what they are doing. They might tie up properties at prices that are actually above market value. They might misrepresent repairs, rents, or other crucial details. Always do your own due diligence on any deal. Never trust a wholesaler's numbers blindly. Get your own inspections, pull your own comps, verify everything. When you find a good wholesaler who actually brings quality deals, build that relationship. A great wholesaler can become your best source of deals. How do you know what a property is actually worth? Wow. What a tay-day are the answer. Comparables are recently sold properties that are similar to the one you are analyzing. Similar means same neighborhood, same property type, similar size, similar condition. The more recent the sale, the more relevant the comp. Sales within the last 3 to 6 months are best. Look at price per square foot to normalize for size differences. A 2,000 square foot house that sold for $300,000 equates to $150 per square foot. If your target property is 1,800 square feet, it should be worth approximately $270,000 in similar condition. Adjust for differences. Your property has an updated kitchen, add value. Your property backs to a busy road, subtract value. Pulling accurate comps is a skill that takes practice to master. One of the biggest mistakes new investors make is underestimating repair costs. This single error has bankrupted more investors than almost anything else. Always overestimate repairs by 10 to 20%. Unexpected issues always arise. Get multiple contractor quotes before closing, not after. Build a scope of work that details every repair needed, line by line, room by room. Here are rough cost estimates that vary by market. A new roof runs $8,000 to $15,000. Vac replacement runs $5,000 to $12,000. Kitchen remodel runs $15,000 to $50,000. Bathroom remodel runs $5,000 to $20,000. Flooring runs $2 to $8 per square foot. Paint runs $1 to $3 per square foot. Windows run $300 to $1,000 each. These are rough estimates. Get actual quotes for your specific situation. And always maintain a contingency budget for surprises. When buying properties to renovate, you need to understand after repair value, or ARV. ARV is what the property will be worth after you complete all renovations. This is different from current value. To calculate ARV, find comps of recently renovated properties in the same area. What are updated, move-in ready homes selling for? That is your target ARV. The 70% rule is a common guideline for flippers. Never pay more than 70% of ARV minus repair costs. If the ARV is $300,000 and repairs will cost $50,000. 70% of $300,000 is $210,000 minus $50,000 equals $160,000 maximum purchase price. This leaves room for holding costs, selling costs, and profit. Conservative investors use 65% or even 60% to ensure adequate margins. Better to miss some deals than to lose money on bad deals if you want to flip properties or wholesale deals. You need a strong buyers list. Your buyers list is a database of investors who are ready, willing, and able to purchase properties. To build this list, attend local real estate investor meetups. Every person you meet is a potential buyer. Advertise your deals in Facebook real estate groups. Run ads on Craigslist. Reach out to landlords in your target areas. Their contact information is public record. Ask existing buyers for referrals to other investors. The bigger your buyer's list, the faster you can move deals. A property sitting unsold costs you money in holding costs. When you have 200 hungry buyers waiting for your next deal, properties sell in days, not months. Buyers are also sources of information. They tell you what they want, what they will pay, and what is selling. This market intelligence is invaluable. Before you buy any property, you need to know your exit strategy. Actually, you need multiple exit strategies. What if the market shifts? What if your circumstances change? Having backup plans protects you. If you buy a rental property, your primary exit might be holding long-term for cash flow. Backup exit 1. Sell to another investor if you need liquidity. Backup exit 2. Refinance and pull out equity without selling. Backup exit 3. Sell to an owner-occupant if the market shifts to favor retail buyers. For flips, your primary exit is renovating and selling to a retail buyer. Backup exit 1. If it does not sell, rent it out. Backup exit 2. Sell at a lower price to another flipper. Backup exit 3. Owner finance to a buyer who cannot qualify for traditional financing. Always know how you will get out before you get in. Making informed investment decisions requires data. Here are tools every investor should know. Zillow and Redfin provide property values, rent estimates, and recent sales. Great for quick research, but not always accurate. Realtor.com and Mel's Access through an agent give you more detailed and accurate data. Public records and county assessor websites show ownership, tax assessments, and transfer history. Census.gov provides demographic data about population, income, and housing. Bureau of Labor Statistics shows employment trends by area. City data.com aggregates numerous data points for neighborhoods. Rentometer and Rent Range help estimate rental values. Bigger Pockets Rental Calculator helps analyze deals. CoStar provides commercial real estate data. Many tools are free. Some require subscriptions. Building a research toolkit is essential for confident investing. Before buying or renovating any property, you must understand permits and zoning. Ignoring these rules can be catastrophic. Zoning determines how a property can be used. Residential zoning means housing only. Commercial zoning means business uses. Mixed use allows both. Some residential zones allow multifamily. Some are single-family only. Check with the city before assuming you can convert a single-family home into apartments. Permits are required for most construction work. Electrical, plumbing, structural modifications, additions, all need permits. Unpermitted work can result in fines, forced demolition, and inability to sell. It can also void insurance coverage and create liability exposure. When buying a property, verify that existing improvements were properly permitted. Unpermitted additions become your problem once you own the property. Always work with licensed contractors who pull proper permits. Proper insurance is your protection against catastrophic loss. Do not skimp on coverage. Standard landlord insurance covers the structure, liability, and loss of rental income during repairs. Make sure coverage amounts reflect replacement cost, not market value. Require tenants to carry renter's insurance. This covers their belongings and provides liability protection. Umbrella insurance provides additional liability coverage above your base policies, typically $1 million to $5 million. As you accumulate properties and wealth, umbrella coverage becomes essential. Well, flood insurance is separate from standard policies and required in designated flood zones. Title insurance protects against unknown liens, easements, and ownership disputes. Consider forming an LAC to provide additional liability protection. Insurance costs money, but being uninsured or underinsured costs far more when disaster strikes. As you build your real estate portfolio, you need to think about entity structure and asset protection. Most beginning investors hold properties in their personal name. This is simple but offers minimal protection. If someone sues you over that property, all of your assets are at risk. A limited liability company, or LC, creates a legal separation between you and the property. Properly structured, if someone sues the LC, your personal assets are protected. Different states have different LSC laws. Wyoming, Nevada, and Delaware are considered the most protective. Some investors use a separate LSC for each property. Others group properties into LSCs with 5 to 10 properties each. There is also the Series LS structure, which offers compartmentalized protection. Consult with a real estate attorney and CPA to determine the best structure for your situation. The cost of proper entity setup is minimal compared to the protection it provides. Successful real estate investing requires meticulous record keeping. Disorganization costs you money in missed deductions and poor decisions. Keep every receipt related to your properties: repairs, maintenance, materials, travel, professional fees, everything. Use accounting software like QuickBooks, Stessa, or Buildium to track income and expenses. Maintain separate bank accounts for each property or at minimum for your real estate business overall. Document everything with photos, especially property condition at move-in and move-out. Keep copies of all leases, tenant applications, and communication. Maintain a file for each property containing purchase documents, closing statements, loan documents, insurance policies, and improvement records. Good records make tax preparation easier. They protect you in disputes with tenants. They provide accurate data for analyzing performance. Build systems and habits now that will scale as your portfolio grows. Contractors can be your best friends or your worst nightmares. Managing contractor relationships is a critical skill. Get multiple bids for every significant project. 3 to 5 quotes minimum. Check references. Call previous clients and ask about their experience. Were they on time, on budget? Did they do quality work? Verify licensing and insurance before work begins. Ask for a certificate of insurance directly from their insurance company. And get TIL'd written contracts that specify scope of work, materials, timelines, and payment schedules. Never pay more than 10 to 30% upfront. Structure payments based on completion milestones. Inspect work before releasing payments. Build relationships with reliable contractors. They are gold. When you find good ones, treat them well, pay on time. Refer them to other investors. Good contractors are booked months in advance because they are in high demand. Renovating properties creates value. Understanding the renovation process is essential for any investor. Start with a detailed scope of work before doing anything. Walk through the property room by room. List every item that needs repair or replacement. Prioritize improvements that add the most value. Kitchens and bathrooms provide the best returns. A fresh paint and flooring make massive visual impact for relatively low cost. Structural, mechanical, and safety issues must be addressed first. Cosmetics come last. Establish a realistic timeline. Renovations almost always take longer than expected. Budget for delays. Coordinate trades properly. Demolition first. Then rough electrical and plumbing, then drywall, then finish work. Having plumbers arrive before drywallers finish equals wasted time and money. Communication is key. Check in daily during active renovation. Problems caught early are cheaper to fix. If you are flipping properties or selling rentals, presentation matters. The difference between a staged property and an empty property can be tens of thousands of dollars. Professional staging costs $1,000 to $5,000 for a typical single-family home. Studies show staged homes sell faster and for 3 to 10% more than unstaged homes. On a $300,000 property, that is $9,000 to $30,000 additional value, far exceeding staging costs. If professional staging is not in the budget, at minimum add furniture to show scale and functionality. Empty rooms look smaller than furnished rooms. Add neutral decor, fresh plants, and lifestyle touches. Make the property feel like a home, not a construction project. Professional photography is equally important. 90% of buyers start their search online. Blurry cell phone photos send potential buyers to the next listing. Invest in professional photos and even video tours. First impressions are everything in real estate sales. Not all appreciation is created equal. Understanding the types of appreciation helps you make smarter investment decisions. Market appreciation happens naturally as property values increase due to economic growth, inflation, and demand. This is passive. You do nothing and values increase. Over the long term, real estate has appreciated approximately 3 to 4% annually nationwide. Forced appreciation is value you create through improvements. Renovating, adding units, raising rents, reducing expenses, these actions directly increase property value. You have control over forced appreciation. Location appreciation occurs when your neighborhood improves, new development, improving schools, declining crime. These factors boost values in specific areas. Smart investors try to capture all three types of appreciation. Buy in growing markets for market appreciation. Improve properties for forced appreciation. Buy in up-and-coming neighborhoods for location appreciation. This maximizes your return potential. Accessory dwelling units, or ADUs, are one of the hottest trends in real estate investing right now. An ADU is a secondary housing unit on the same property as a primary residence. This could be a converted garage, a basement apartment, or a separate backyard cottage. Many cities have loosened zoning restrictions to allow ADUs as a solution to housing shortages. Adding an ADU can dramatically increase property value and cash flow. A property that generates $2,000 in rent becomes a property generating $3,500 with an ADU added. ADU construction costs typically range from $50,000 to $300,000 depending on size and complexity. But the value added often exceeds construction costs significantly. Research your local ADU regulations carefully. Some cities make ADUs easy, others make them nearly impossible. Where ADUs are permitted and encouraged, this strategy can be incredibly profitable. Earlier, I mentioned the BRRRR strategy. Now let us dive deep into how this wealth-building machine actually works. BRRRR stands for Buy, Rehab, Rent, Refinance, Repeat. Step 1. Buy a distressed property significantly below market value. You are looking for properties that need work but have strong underlying fundamentals. Step 2. Rehab the property. This is where you force appreciation through strategic improvements. Step 3. Rent the property to a qualified tenant. Now you have cash flow. Step 4. Refinance based on the new, higher value. Most lenders will refinance at 70 to 75% of appraised value. If your all-in costs are at or below that amount, you pull out most or all of your initial investment. Step 5. Repeat. Take that capital and do it again. Let me show you exactly how BRRRR creates wealth with a real example. You find a distressed property and purchase it for $100,000. You invest $40,000 in renovations. Your total investment is $140,000. After rehab, the property appraises for $200,000. You refinance 75% of appraised value. That is $150,000. After paying off your initial purchase and rehab costs, you have $10,000 back in your pocket. Plus, you own a property that cash flows $500 per month. You invested your time and effort, but you have no money left in the deal. Now do the math. If you repeat this process 5 times per year, After 5 years, you own 25 cash-flowing properties with almost zero of your own money tied up. This is how ordinary people build extraordinary wealth. The hardest part of BRRRR is finding properties with enough spread between purchase price and after-repair value. You need properties at significant discounts, typically 70% or less of ARV after accounting for repairs. These deals rarely appear on the MLS. You need to go off-market. Use direct mail campaigns targeting owners of distressed properties. Build relationships with wholesalers who specialize in finding these deals. Network relentlessly at local real estate investor meetups. Drive for dollars through target neighborhoods. Contact owners of properties in probate or foreclosure. The competition for BRRRR deals is fierce. Everyone wants these properties. You need to be aggressive in your marketing and fast in your decision-making. When a good deal appears, you may have hours, not days, to make an offer. Be prepared. If you want to make money fast in real estate, flipping houses might be your path. House flipping involves buying distressed properties, renovating them, and selling for profit. Unlike rentals, there is no ongoing cash flow. You invest, execute, and cash out. Successful flips generate profits of $20,000 to $100,000 or more in a matter of months. But flipping is not easy money. It requires accurate deal analysis, reliable contractor relationships, sufficient capital, and the ability to manage complex projects. Many beginners lose money on their first flips due to underestimating repairs, overestimating ARV, or encountering unexpected problems. The market for flipped homes can also shift quickly. If the market slows while you are mid-renovation, your projected profit can vanish. Flipping is exciting and potentially very profitable, but it carries real risk. Here is a debate that rages in real estate communities. Is it better to flip or hold? Flipping generates immediate profits. You could make $50,000 in 6 months. That is compelling. But you pay ordinary income taxes on flip profits, not the lower capital gains rates. A $50,000 profit might become $35,000 after taxes. And then what? You need to find another deal. You are trading time for money. Holding generates ongoing income, cash flow, appreciation, principal paydown, tax benefits. The returns compound over time. A property you buy today might generate $1 million in wealth over 30 years. But you need patience. The big payoffs come later, not immediately. My recommendation: use flipping to generate capital for holding. Flip a house, take the profits, and buy a rental. You get immediate money and long-term wealth building, best of both worlds. What if you have $0 to invest? Wholesaling is your entry point into real estate. Wholesaling involves finding properties under contract and then assigning those contracts to other investors for a fee. You never actually buy the property. You are essentially a deal finder, connecting motivated sellers with investors who want to buy. Assignment fees typically range from $5,000 to $20,000 per deal. Some wholesalers do dozens of deals per year. The beauty of wholesaling is that you need very little capital to start. Your costs are marketing, direct mail, driving for dollars, online ads. But wholesaling is hard work. You need to generate leads, negotiate with sellers, build a buyer's list, and close deals. The failure rate is high because people give up before gaining traction. But wholesaling teaches you the fundamentals of deal analysis, negotiation, and networking. Many successful investors started as wholesalers before scaling into buy and hold. If you want to build a large portfolio fast, multifamily investing is the way. Instead of buying one house at a time, buy 5 units, 100 units at once. Multifamily properties offer economies of scale. One roof covers multiple units. One property manager handles the entire building. One loan finances the whole thing. The numbers get exciting quickly. A 100-unit apartment building, generating $400 per unit per month in cash flow, equals $40,000 per month. That is $480,000 per year in cash flow from a single property. Getting into multifamily requires more capital and more sophisticated analysis. Commercial lending rules apply for properties of 5 units or more, but the rewards justify the additional complexity. This is how real estate investors graduate from small-time landlords to serious wealth builders. Analyzing multifamily properties requires understanding different metrics than single-family homes. Start with gross potential rent, what the property would generate if 100% occupied at market rents, then subtract vacancy, typically 5 to 10% depending on the market. Then subtract operating expenses, property taxes, insurance, utilities, management, maintenance, repairs, landscaping, trash, and reserves. What remains is net operating income, Divide NOI by the purchase price to get your cap rate. Compare this to market cap rates for similar properties. If market cap rates are 6% and your deal is at 7%, you might be getting a discount. Also calculate price per unit. A $2 million property with 20 units equals $100,000 per unit. Compare this metric to recent sales. Finally, calculate price per square foot. These multiple valuation methods help ensure you are paying a fair price. The biggest profits in multifamily come from value add strategies. Value add means buying a property that is underperforming and improving it. This could mean renovating units to command higher rents. A $10,000 unit renovation that increases rent by $200 per month creates massive value. At a 6% cap rate, that $2,400 annual rent increase equals $40,000 in property value. From a $10,000 investment, value add could also mean improving management. Many apartment buildings are poorly managed with below-market rents and high vacancy. Simply bringing in professional management can boost NOI significantly. Value add could mean reducing expenses, negotiating better contracts, improving energy efficiency, adding revenue streams like laundry or parking. The goal is increasing net operating income. Every dollar of increased NOI typically adds $10 to $15 of property value. Eventually, many investors consider moving into commercial real estate, office, retail, industrial, and specialty properties. Commercial real estate operates differently than residential. Leases are longer, often 5 to 10 years. Tenants often pay for their own expenses through triple net in-end leases. This means more stable, predictable income. Commercial values are based almost entirely on income. Emotion and comparables matter less, but commercial also carries different risks. EOS. When a commercial tenant leaves, the space can sit vacant for months while you find a replacement. Economic downturns hit commercial harder than residential. People always need housing, but businesses close. Financing is different. Down payments are higher. IRAs. Underwriting is more complex. Commercial real estate is not for beginners, but for experienced investors seeking to scale into larger assets, commercial can offer compelling returns. Let me tell you about one of the most underrated real estate investments: self-storage. Self-storage facilities are incredibly simple. Boxes of varying sizes that people rent to store their stuff. No toilets to fix, no kitchens to remodel, no tenants living on site causing problems. Operating expenses are minimal. Typical expense ratios are 30 to 40% versus 50 to 60% for apartments. Many self-storage facilities run on skeleton staffing or even fully automated with keypad access, and demand is strong. Americans accumulate stuff and need places to store it. Economic downturns actually increase demand as people downsize homes but keep their belongings. The self-storage industry has been one of the best performing real estate sectors over the past 2 decades. Returns have beaten most other property types. If you can find or develop a well-located self-storage facility, you might have found your gold mine. Here is another hidden opportunity that few investors consider: mobile home parks. The concept is simple. You own the land. Tenants own their mobile homes. They pay you lot rent for the privilege of placing their home on your land. Lot rents typically range from $200 to $600 per month, depending on the market. Your expenses are minimal. You are just maintaining roads, utilities, and common areas. On cash returns of 15 to 25% are common in this space, and here is the beautiful part: there is virtually no new supply. Very few municipalities zone for new mobile home parks. Existing parks are becoming more valuable as demand increases. The tenant base is sticky. All fence moving a mobile home costs thousands of dollars, so tenants rarely leave. Sam Zell, one of the most successful real estate investors in history, made billions in mobile home parks. This unglamorous asset class deserves serious consideration. The rise of platforms like Airbnb and Vrbo has created a whole new category of real estate investment: short-term vacation rentals. Instead of renting to long-term tenants at $1,500 per month, what if you could generate $300 per night? In the right market, vacation rentals can generate 2 to 3 times the income of traditional rentals: a beachfront condo, a cabin in the mountains, a downtown apartment in a tourist destination. These properties can be cash machines, but vacation rentals require work. You need to manage bookings, coordinate cleaning, handle guest communication, maintain furnishings, and deal with higher turnover. Many cities have implemented strict regulations on short-term rentals. Some have banned them entirely. Operating costs are higher. Furnishings, linens, amenities, utilities, cleaning fees, platform commissions. Income is also more seasonal and unpredictable. When travel crashes like it did in early 2020, so does your income. Short-term rentals can be incredibly profitable, but require more active management than traditional rentals. As you advance in your real estate journey, you may consider the ultimate value creation strategy, development. Developers transform land and create new properties. They take raw dirt and build apartment complexes, shopping centers, and subdivisions. The profits can be enormous, often 30 to 50% returns or more, but the risks are equally enormous. Development requires significant capital, extensive expertise, long timelines, and navigating complex regulatory environments, zoning approvals, environmental reviews, permitting delays, cost overruns, interest rate changes, market shifts during the construction period. A project that made sense when you started might not make sense 2 years later when you finish. Most failed developers fail because they underestimate complexity and overestimate their abilities. Development is for experienced investors with deep pockets and strong teams. It is not for beginners. But understanding development helps you appreciate where real estate profits really come from. You do not have to do this alone. Partnerships can help you achieve more than you ever could individually. Maybe you have deal-finding skills but no capital. Partner with someone who has money but no time. Maybe you have renovation expertise but no properties. Partner with an investor who needs a project manager. Maybe you have found a deal too big for you alone. Bring in partners to share the equity. Partnerships expand what is possible, but partnerships also create potential for conflict. Before partnering, establish clear agreements in writing. Who contributes what? Who makes which decisions? How are profits and losses split? What happens if someone wants out? Get everything documented legally. More partnerships fail due to poor communication and unclear expectations than due to bad deals. Choose partners carefully. Communicate constantly. Document everything. Real estate is not just about your financial freedom, it is about generational wealth, which is about the wealthiest families in the world have passed down real estate holdings for generations. Properties purchased 50 years ago for $50,000 are now worth millions. Cash flow that started as $300 per month is now $3,000 per month. Mortgages that once consumed income are now paid off, and these assets pass to children and grandchildren. Estate planning with real estate is powerful. Stepped-up basis at death means heirs inherit at current market value, wiping out capital gains. Family limited partnerships can transfer ownership while reducing estate taxes. Proper structures can protect assets from creditors, lawsuits, and divorces. Think beyond your own lifetime. The properties you build today can support your family for generations. That is the ultimate goal of real estate investing. Building wealth is one thing, protecting it is another. As your portfolio grows, you become a target. Lawsuits are everywhere. A tenant slips and falls, a contractor gets injured, a guest at your property has an accident. Suddenly, you are facing a lawsuit. Asset protection starts with proper insurance. Umbrella policies provide additional liability coverage above your base policies. Entity structure matters. LLCs create separation between your personal assets and business assets. Keep business and personal finances separate. Commingling funds pierces the corporate veil and exposes personal assets. Document everything meticulously. Good records protect you legally. Consider asset protection trusts in favorable jurisdictions. Some investors go further with offshore structures, though this adds complexity and cost. The more wealth you build, the more important protection becomes. Do not wait until you have a problem. Put protections in place now. Real estate does not go up in a straight line. There are cycles, and understanding them helps you make smarter decisions. The typical real estate cycle lasts approximately 18 to 20 years. Within that cycle, there are periods of expansion and periods of contraction. We saw a major contraction in 2008 through 2012. Property values crashed, foreclosures skyrocketed, and many investors lost everything. We saw a major expansion from 2012 through 2022. Values doubled or tripled in many markets. Where are we now? That is always the question. Rising interest rates in 2022 and 2023 slowed the market significantly. Transaction volumes dropped. Prices softened in many areas, but long-term fundamentals remained strong. Population growth, household formation, limited new construction. Investors who survived past downturns often thrived by buying during fear and holding through recovery. Do not try to perfectly time the market, but understand where we are in the cycle. Let me share the biggest mistakes that derail new investors so you can avoid them. Not doing enough due diligence. Every property has issues. Find them before closing. Mistake 2. Underestimating repair costs. Add a 20% contingency to every estimate. Mistake 3. Overestimating rental income. Use conservative assumptions. Mistake 4. Paying too much. Profit is made when you buy, not when you sell. Mistake 5. Insufficient cash reserves. When emergencies hit, cash is king. Mistake 6. Poor tenant screening. One bad tenant can cost you tens of thousands. Mistake 7. Emotional decision-making. This is a business. Run the numbers. And mistake 8. Trying to do everything yourself. Build a team. Mistake 9. Analysis paralysis. At some point, you have to take action. Mistake 10. Giving up too soon. Success takes time. Every experienced investor has made mistakes. The key is learning from them and not repeating them. Success in real estate is as much about mindset as it is about strategy. Successful investors think long-term. They do not obsess over daily fluctuations. They make decisions based on where they want to be in 10 or 20 years. Successful investors embrace continuous learning. The industry evolves, and markets change. Strategies that worked yesterday might not work tomorrow. Reading, networking, and education are lifelong commitments. Successful investors take calculated risks. They do not gamble recklessly, but they also do not hide from opportunity. They analyze, plan, and act. Successful investors build relationships. Real estate is a people business. Your network is your net worth. Successful investors are patient. Wealth building is not a sprint, it is a marathon. Years of consistent effort compound into extraordinary results. Successful investors persist. They face setbacks, failures, and challenges, and they keep going. Winners fail more than losers try. Before you make another move, you need a plan. A real, written, specific investment plan. Start with your why. Why do you want to invest in real estate? Financial freedom, early retirement. Generational wealth, passive income. Your why will keep you motivated when things get hard. Define your goals in specific, measurable terms. Not I want to be rich, but I want $10,000 per month in passive income within 10 years. Identify your strategy. Will you focus on single-family rentals, multifamily, flipping, BRRRR? Choose your market. Where will you invest? Create a financial plan. How much capital do you need? How will you acquire it? What financing will you use? Set milestones. Where do you want to be in 1 year, 3 years, 5 years, 5 years? Write it down. Review it regularly. Adjust as needed. A plan turns dreams into actionable steps. You have made it through 98 chapters of intensive education. You now know more than 90% of aspiring investors, but knowledge without action is worthless. Information does not create wealth, implementation creates wealth. So here is what I want you to do today, not tomorrow, not next week. Today, take one action toward your real estate investing goals. If you have not gotten pre-approved for financing, call a lender today. If you have not attended a local real estate investor meetup, find one and register today. If you have not started analyzing deals, pull up Zillow and analyze 3 properties today. If you have not educated yourself enough, order a book or sign up for a course today. Small actions compound into massive results. The journey of 1,000 miles begins with a single step. Take that step now. We have reached the end of this incredible journey, but for you, this is just the beginning. Right now, at this very moment, you stand at a crossroads. One path leads to the same life you have always lived, working for someone else, trading hours for dollars, hoping Social Security will be enough, worrying about money until the day you die. The other path leads to freedom, financial independence, passive income, generational wealth. The ability to live life on your terms. Real estate has created more millionaires than any other investment vehicle in history. The knowledge is available. The tools are accessible. The opportunity is real. The only question is, will you take action? I believe in you. I believe that you have what it takes to build wealth through real estate. I believe that 1 year from now, 5 years from now, 20 years from now, you can look back at this moment as the turning point, the moment everything changed, the moment you decided to stop dreaming and start doing. Your wealthy future awaits. Now, go build it. Thank you for staying with me through all 100 chapters of this comprehensive guide. If this content has provided value, share it with someone who needs to hear it. Subscribe to the channel for more content like this, and most importantly, take action. Remember, the best investment you can ever make is in yourself. Your education, your mindset, your action. Keep learning, keep growing, keep building. Until next time, let us go get wealthy.